Okay, I think we're ready to get started. Thank you all for joining today's webinar. Hope everyone's having a good day so far. So today's webinar is co-hosted by Irwin and LodeRock, and the topic is offense versus defense, how to shape your IR strategy in a market downturn. So as a quick introduction to the topic, a market downturn can be one of the most demanding times to be involved in investor relations. While some management teams choose to retrench and communicate less in difficult times, it's very often not the best solution. Staying proactive and educating investors about where and how you're focusing your efforts can be challenging, but it's crucial to protect your credibility and trust with the investment community. Today, we'll be covering the importance of maintaining an active marketing program during a downturn, selling management on a proactive path and strategy forward, and how and where to focus your efforts that lead to the best outcomes, and then finally, getting ready for an upturn. Just as a quick matter of note, there will be a brief period for Q&A at the end of this webinar. So if you have any questions that you'd like to ask any of the panelists, feel free to type it into the Q&A box and we'll answer them at that time. So with that, I will introduce myself. My name is David White. I am the CEO and co-founder of Irwin. For those of you that don't know, Irwin was launched in 2017 and is an award-winning investor relations and capital markets software company based in Toronto with global operations. Irwin enables leading organizations to manage their investor relations programs with a modern, easy-to-use, integrated product, differentiated and comprehensive investor and shareholder data, a commitment to excellent service, and a powerful suite of investor relations tools. Our platform is trusted by thousands of global users, and we service companies of all industries and market caps. Also, I'd like to give a big thank you to the webinar partner, LodeRock Advisors. LodeRock helps issuer companies chart a path to success in the capital markets through an institutional quality investor relations program. LodeRock's team of senior practitioners draw on deep experience as they work with issuer clients to deliver transparent, consistent, accessible, and compelling investor relations communications. So with that, I'll quickly introduce you to our fantastic panelists today, starting with Gus Papageorgiou, who is head of investor relations at Lightspeed HQ. In the past, Gus occupied the position of head of research at PI Financial, director of technology research at Macquarie Capital Markets Canada, managing director of equity research and technology at Scotia Capital. Following Gus is Michelle Robital, and the managing director, she is managing director and head of responsible investing at Guardian Capital. In this global role, Michelle has responsibility for the consistent integration of responsible investing principles into Guardian's investment processes. Prior to joining Guardian, Michelle worked as an equity research analyst for various Canadian investment dealers, including Scotia Capital and National Bank Financial. And finally, last but certainly not least, Ian Tharp is a capital markets communications principal at LodeRock. He is a senior leader with extensive experience in investor communications and sustainable business opportunities. Most recently, Ian led the sustainability office at Algonquin Power and Utilities as VP of Sustainability, after leading Algonquin's investor relations team during a period of significant growth in capital formation. Ian has over 20 years of buy and sell side experience with a specific focus on renewable energy, electric utilities, and clean tech. Okay, great. So with that, we will start our question period with our fantastic panelists. So we'll start off with Gus. So Gus, we'd love to know how, if at all, have you changed your IR practices and strategies during this most recent downturn?
I don't think we changed all too much, really. I think what's happened is that our audience has changed. When things were rocking and rolling, our audience is mostly very growth-oriented investors. And as the markets have come off, we've shifted more, I think, towards value investors, or at least GARP type investors. So our audience has definitely changed. Also, I would say that, as the markets have come off, we're probably seeing a lot more Canadians versus international investors that are coming to us. And so I think the only thing that really has changed is again, as your audience changes, the way who you're targeting, who you're getting management in front of is going to change as well. But no, we're still very much involved in conferences, very much involved in doing one-on-one sessions and We maintain our capital markets days and webcasts to kind of communicate with investors on a regular basis.
Awesome. So your level of proactivity has remained the same, just your audience has shifted a little bit.
I'd say that's absolutely right.
Got it. Awesome. Okay, this next question is for Ian. So Ian, have you had to debate this topic with senior management of your clients, i.e., do we dial back IR significantly? If so, what are you doing to persuade them to stay the course? Or is it highly dependent on the company's situation, such as market cap, financial performance, anything like that?
Yeah, I mean, definitely an important time for us to continue to interact with management around kind of the value of IR. But, I kind of jump on Gus's themes where he sounds equally as busy now as he was before. Maybe the emphasis of activity is a little different. So really, we're trying to emphasize to our clients to maintain a very active IR program. Budget-wise, I think there are ways to shift your practices to lower IR-related costs. Maybe you're dialing down some of the higher investment items like travel for investor marketing. The world has become much more accustomed to things like this, which is kind of the virtual interaction with investors and investment banks, analysts. And then maybe a little bit less on the paid for conferences, so the retail focused conferences where you may pay dollars to get in front of audience might take less kind of priority. In terms of looking at the audiences, first I'll start with the analysts. You could think that they need more time with you now because this is a very uncertain time and they need to be able to navigate through these markets and inform their clients and their sales desks, especially those that are launching new coverage. Investors, same thing. The due diligence we've seen can be quite elongated with certain companies. They want to make sure that they're maybe entering your market for the first time at the right time, and then also your name. And then they'll also want to see what economic indicators are having impacts on you. So be it supply chain or FX or interest rates, those types of things, they'll want to understand more about that, and that takes time. So, I think the upshot is you can't go radio silent on your audiences. Easier to maintain clients than to gain them, and you certainly don't want to lose them. And then I'll kind of emphasize what Gus had said. Maybe your audience has changed. If your valuations have come down, maybe you're now talking to less growth-oriented investors and more value-oriented investors, which are still very valid places to, focus your time.
Awesome. Thanks, Ian. So the next question is for Michelle. So Michelle, as we've advanced through the current market uncertainty, how have you and your team shifted your issuer and sell side engagement practices?
Yeah, I think I would say that, we probably increased the cadence of regular contact. We would normally be in touch with our management teams fairly regularly, but, when there's a lot of uncertainty, a lot of moving parts, you just want to make sure that you're in very constant and consistent contact so that you know what's going on. And that's true whether or not things are going well for that underlying company, but it's actually even more important if things aren't going well. It's not that we company to have all the answers, but we really want an indication. They're a lot closer to what the different metrics are and the different impacts on their companies. And it's really important that we're getting updated. I think Ian mentioned the concept of trust between investors and investee companies. And I think that being accessible during times like this, making sure that if they have questions or they have concerns, that you're actually out there addressing it, is really critical to maintaining that trust and maintaining that relationship on a long-term basis.
Yeah, it's super helpful. Just as sort of an overarching point, this statistic that I often cite with clients that when we're having sort of conversation is that there was a study conducted where they looked at companies that sort of retrenched during a down market versus companies that kept their pedal to the metal and stayed proactive. And the companies that stayed proactive coming out of the down market and on the upturn, they got a 20 to 30% valuation lift versus those that didn't. So for me, that's a sort of absolute number. Obviously, lots of factors go into that, but I think it's pretty telling. Okay, great. So this is a question for all three of you. How have you found it materially more difficult to get an audience in these market conditions? Comment on any changes to shareholder engagement or outreach. And Gus, maybe we'll start with you.
Yeah, I think we've been pretty fortunate. We haven't really seen any decline in engagement with the buy side. In the last month, I think we've had two sell-siders launch coverage on us. So the activity has remained high. But I'd say that, the conversations and the audience again has shifted, whereas say 18 months ago, it was all about how fast can you grow. The conversations now are how quickly can you get profitable. And again, you're talking to a different audience and the messaging has to change. But we've been pretty fortunate that the interest in our name at least has remained pretty high.
Great. Ian, any thoughts on that?
Yeah, I guess I have the benefit of looking across, our kind of client base, which let's for round numbers, let's say it's around 50 clients. And yeah, we've seen it's definitely more challenging. I think Michelle's interesting where she wants to, maintain or amplify her issuer outreach. But, I think in general, for a lot of these growth oriented names, technology focused names, they've come off so hard that I think it is in a lot of cases harder to get audience. We do go to these retail focused kind of pay for play conferences, and the one-on-one schedules at those is a lot less. So companies need to consider those a little more closely, that maybe they don't get a full day of 6 to 8 meetings. It's more 2 or 3. But I think it goes back to the IROs still needing to be proactive, figure out new ways to showcase their companies. And, a couple things. One is who holds your peers, who's gone in and out of your peers. That shows activity in your sector. And also other companies that have similar investment attributes to you. Just keeping an eye on those types of things, but also using things, giving a plug to Irwin. We use Irwin very readily to try and track investor movements in and out of other stocks, which can help us kind of maintain that activity level.
Yeah, that's interesting. Michelle, you made a comment about sort of being truthful and honest. And one thing that I think is also important is not just with your shareholder stakeholders, but also with yourself. And we see a lot of companies that are maybe, again, 12 months ago they were a growth stock, or should consider themselves to be a growth stock, and now they're not. But they're sort of hanging on to that. And I guess curious to hear from you whether you see that maybe as you get the outreach conducted your way, and whether you see companies sort of with the same pitch that you would have 12 months ago. Like any comment on that would be helpful, I think, for our audience.
Yeah, I mean, I think frankly, the ability of companies to shift that messaging is really critical to their long-term success. Anything. So I would say, that's not the part of the market that we tend to play in a lot. We tend to be sort of more stable, steady investors as opposed to high growth investors. But I would say that, where there is growth and those types of companies, like, you need to be very clear. Like, I think, again, as Gus mentioned, the path to profitability is really important. What are the growth prospects? Like, people are looking for more solid long-term fundamental indicators. And I think you need to be very upfront about what your prospects are and what the pipeline is, because again, people are looking for credibility. They're looking for, is your story playing out the way that you're telling, saying that it's going to. And as we move through these downturns, and it's one thing to continue to say that, well, this is what brought it offside, but you have to be very realistic about the expectations that you're setting for investors. And you always want to be careful that you're over-promising and under-delivering, not the other way around.
Yeah, absolutely. That's great insight. Okay, great. So this is a question for all again. We'd like to know what specific new IR related strategies or tools or disclosure have you introduced through this downturn? And maybe we'll start again with Gus.
Yeah, it's not necessarily new, but I think we're going to rely more on one of the tools we've been using is podcasts, where I sit down with a member of our senior management team to kind of discuss one topic in depth. So in the past, I've had discussions with the head of payments, with current CEO at the time who was president, to kind of talk about the strategy. But I think it's, having these podcasts is a great way to focus in on one specific topic, do a real deep dive. And it's a real good way for the buy side to consume that content whenever they want, right? They can listen to it as they're working out or driving into work. And I think, so we've done a few of those in the past. I think we're going to be doing more of those. We do have some new members to our C-suite. I think the street wants to get to know them better. And so kind of doing these like one topic deep dives in a podcast format, I think has proved very effective for us in the past. And I think we'll continue to do more of that in the future.
That's great. Ian, anything that you'd add on the sort of new tools or disclosure, any new strategies?
Well, first I'll say that, I mean, maybe Gus is the test case for what you should do. Because I think, especially if you're changing your management team and you're trying to change some of your messaging, some of these deep dive moments that you can amplify through a podcast is great. Not all companies are set up to do that well. So, the first one's probably very painful and the next ones are pretty easy. But I think if you establish that signal to your investors, investors are digesting information very differently now, investor information. So sticking with that, I mean, I think the podcasts are a great example of how people are consuming investor info. We kind of generally talk about alternative channels, and that might include social media. So you're using, in some cases, Facebook, Twitter, Instagram, LinkedIn. You have to make sure that you're targeting the right channels for the right audiences. But there are ways to get very specifically to the audiences that you want for your stock through those channels. The next thing, and probably everyone's seen these because kind of through COVID, all the brokers went this way, are these national retail calls. So, maybe the tier one banks were the best, but there are others out there that do it. Instead of doing a broker meeting where you buy lunch for a bunch of brokers and they listen or not, and, you tell your story, these are 1 hour kind of curated Q&As with companies that the advisors can digest whenever they want. They can, I think the uptake on viewership is pretty high. And it's a great way to blanket the company or the country for brokers that might be in the CIBC or Scotia or other systems. So that's a great way. And then one final thought, I mean, for my background in the last little while, we've had to focus much more on balance sheet. So for a strategy, people want to know that you're paying down debt levels, that your cash, kind of the nature of your cash flows through these downturns, and then a little bit more scenario analysis around kind of floor EBITDA, if you want to call that a strategy. But I think more communication around that gives people like Michelle and other investors a bit more kind of downside understanding of what could happen with your company.
Yeah, so maybe that's a good segue into Michelle. Michelle, interested to hear what you think works for you and your colleagues as it relates to maybe some unique strategies.
Yeah, I mean, I really like the idea of the podcast. I think one, it gives an opportunity for you to get to know different members of the management team, which is always nice because you want to see some bench strength in these companies and you want to hear from different people. But I would say it also, the concept of kind of a fireside chat. So whether or not that's through a conference, some conferences are set up in that format. I think that's much more compelling than just a company pitch. Or some sort of forum where you can actually have someone really talking to you about, like, what are the key issues that investors want to know about, right? For every company, there's some key questions or key issues that people want to know about, they want to focus on. Ian mentioned balance sheet, the good one, or what your base, your bottom level or downside protection is, or what have you. But, I think it's a great forum if you can find an avenue, whether it's a podcast, whether it's a conference, whether it's a broadcast, like Ian was talking about, through those retail channels, where you're telling your story in a way that you're really trying to focus on. Here's the key issues that people are thinking about right now. What's our, what does my customer demand picture look like? What are my supply chain issues? Those sorts of things that are really topical. I think that's really meaningful to investors.
That's great. Thanks, Michelle. Okay, great. So this next question is for Gus and Ian. We'd like to know if you're having to spend more time demonstrating the value of IR internally. And if so, what have you learned? I think this is a really important question for the audience, right? I'm sure a lot of them are getting some pressure from management as it relates to the stock price and spend, and I think your insights here would be really helpful. Maybe we'll start with Gus.
Yeah. When the stock's high, everybody's taking credit for it, and when the stock's low, everybody blames IR. But I'm joking. That's not the case here at Lightspeed. No, I think it's actually the opposite. When things are going well and the stock is high, people, they're not as focused on it. When the stock is under pressure, though, there is, I think, renewed interest in IR, heightened interest in IR, especially by our senior management in terms of, how do we communicate the message? Who do we talk to? How do we get people to understand, our company, our products, our strategy? So I'd say no, it's. But to me, my experience anyways, it's been the exact opposite, that as the stock comes under pressure, the importance of IR and the need for IR to engage with the investor community increases.
Awesome. Ian, any thoughts on that? I think also the audience would love to hear, how do you maybe combat some of those objections from management, right? Where they're saying, no, we need to spend less, et cetera, et cetera. Maybe some ammo for the team would be great.
Yeah, I mean, maybe Gus's management team is kinder when times are tough. But I had one prior leader I worked with. Anytime the share price was down, he'd take his big hand and hit my window of my office, and it would scare the heck out of me. And when times were good, he was basically skipping down the hallway. So, yeah. So I think in general, there's more scrutiny of the IR team's efforts in these tough times. You know, and I kind of feel for the leadership teams, because they're probably hearing it from their board. They may be getting direct interaction with investors who are wondering, okay, what's the path forward here? So, you know, I think definitely more scrutiny of what the IR teams are doing. We talked a little bit before about why an IR team should stay active in these kind of markets. So I won't repeat those, but, you know, I think one thing, you've established a disclosure cadence with your audiences. You definitely need to stay consistent or continue to up that game. You can't, you know, turn off some of those signals that you've established with your audiences. You know, also, I think IR teams have to be realistic about the benefits of certain efforts, like going to conferences I mentioned before. Maybe you're not getting those full one-on-one days. You know, maybe you can't set up that full non-deal roadshow to Boston and New York anymore because there's not so much interest in your sector. But maybe there is. So, you know, you need to keep trying. And then the other thing, which I think helps contextualize the challenges that companies having, is just kind of context on where your company is trading relative to your industry or your specific peers. And maybe it's a bit more data analysis around that, which again, you're using data sources like, you know, Bloomberg, Irwin, and others to kind of contextualize that, or analyst work. But yeah, I think there's still a lot of value for IR, but yeah, we tend to be the sharp end of the stick in tough times. So
yeah, I would just add to that and say that from my experience, investors have a fairly long memory, in the sense that if you all of a sudden go away, they're going to remember it. And like, this is, at the end of the day, this is a relationship management business. And so even if, you know, the other side of the relationship isn't, you know, coming to the table because whatever, they're busy, they're maybe not interested at the time, they're certainly going to remember if you also didn't come, or if you did. So super important. Maybe with that, we'll go to Michelle, where she can speak to this a little bit as well. So as a portfolio manager, what would you like to see from issuers and the sell side as we navigate the markets in 2023?
Yeah, so I will just reiterate the points that both David and Ian made. So I do think that consistency in communication, being very regular in terms of your ability, both your outreach to your investors and to the communications that you have. If you've been having a regular communication in place, it is not the time to change it or to take it away. You know, people are used to that consistency. They're used to seeing the reports that you're putting out, and they're going to wonder why it's not there if it's not there. And it's generally not in a favorable light. So I think the thing I'd also say, be as upfront as you can. You know, I think investors recognize that, you know, there are considerations you have to give, and sometimes you have to be a little bit careful, but as much color as you can provide, you know, you're the ones that know the points for your specific business. You know, where the challenges are, what you're doing to address them, where you're sort of looking at in terms of inflection points, in terms of things that you're looking for. You know, those things are really important for investors. And again, they just help build confidence that the management team knows what it's doing. It's looking at the right things. And again, it builds that relationship and that trust. And so, you know, I think there is a lot of information on the macro environment. When we think about the sell side and what we like to see there, you know, a lot of sensitivities. Obviously, right now, people are really focused on inflation and what the impacts are in rates, FX, you know, just this macro uncertainty that we're seeing, issues with sell side, issues on the demand side. You know, the more information you can give really specific to your underlying business, the better it's going to be for investors. They just want to understand what's going on. People are willing to give you a pass, as you know, if your company is going through a bit of a downturn for a period of time, particularly in this kind of environment, but they want you to be able to talk about it, and they want to understand what's going on in the business, and that it's not just sort of this black box that we're all hoping at the end of the day is going to come out on the other side. We want to understand what's going on through the piece.
Super helpful. Maybe if I could just ask you like a fairly blunt question, you don't have to give us specific examples, but can you recall a time where maybe you or your colleagues had a really good relationship with a company, and maybe you were a shareholder, maybe you weren't, and then maybe something happened, maybe it was macro or micro specific to the company, and they just went completely silent? I guess I'm curious to hear whether you can recall you applying a discount to that company in the sense of, okay, well, they've just disappeared.
Yeah, I mean, I think that it would be, I would say that the way that we tend to invest, it's always about increment. You're increasing your level of conviction in the company, and that really allows you to increase the weighting that you're putting into that company and within your portfolio. And I would say that certainly it has happened. We have had companies that have gone radio silent. It's not positive. And I would say your level of conviction goes down very dramatically. It takes a lot longer to lose conviction in a company than it does to build conviction. So, if I going on in a company and it's this cloud of uncertainty and I'm not getting any information I need, the weighting in the portfolio is coming down pretty quick.
Yeah, absolutely. Okay, great. So on to the next, and I think this is a question for everyone. We'd love to hear how over the last 12 months, given, the material declines in share prices, have you found that greater board engagement in IR through this period? And have you found, has that gone up, down? Has it become sort of more pervasive at certain times? Just any sort of commentary on your engagement with the board would be great. And then any advice you have on how to manage this as well. So maybe we will start with Ian. We will toss it back to you.
Sure. And, I'll preface all this by speaking as an external consultant IR resource. And, I think Gus would have different experiences being directly linked with the CEO and CFO and maybe a step closer to the board. But, I think in general, we've seen more scrutiny. I think I mentioned that of IR activities by management. And again, management is on a number of hot seats. One is operationally, how is the business operating? And two is, okay, well, how is the share price performing? So, I think, yes, there's more scrutiny, but I don't think they're going to look at IR as the source of the challenges in the share price, right? It's the market that's really happening to it, and then you just need to make sure you're maintaining a robust IR program. But they'll want to understand how their shareholder base has changed. If I was a director, I'd want to know whether there's an increasing short interest or any activist investors entering my world, because those need close monitoring. And then, yes, everyone comes down in a down market, but have I suffered more greatly than my peers? I mean, it's sometimes hard to say I'm less bad than someone else. But there is some comfort in that. And it says that your kind of communications are getting across to your audiences effectively. So some thoughts on there. Yeah,
really helpful. Gus, any thoughts from you?
Yeah, I'd say, we're pretty fortunate. We have a couple of board members who were former CFOs of Google and OpenText, and so they've seen the ups and downs. And Patrick Pichet, who was on our board, was also on the board of Twitter, so he's seen some pretty hectic times. So I think we have a level of experience in the board, especially with with people who are in senior management positions at other technology companies, and they understand the volatility. I'd say that the board has always been pretty active and has remained so, but I would say they've been very supportive. So I wouldn't say that anything has changed too much through the downturn, because I think, especially when you're in the tech space, I mean, the share price is just much more volatile than normal, and that's something you just have to become accustomed to.
Yeah, absolutely. And what about you, Michelle? Have you been increasing your engagement with boards of companies that you're investing in, if at all?
Yeah, I mean, I would say just, and not necessarily related to the market uncertainty we've been going through over the last number of months, but I would say just from a responsible investing standpoint, investor engagement with boards has become a much bigger topic. I think investors have become a lot more focused on board governance, what the board is doing, how involved it is in terms of the operations, the operating strategy, any kind of, transition strategy that's taking place within the company. And so I think that what you're starting to see is a lot more sort of somewhat regular interaction between investors and boards. And I would say, I think once a year is probably the right cadence. I don't think it probably needs to be more than that, but I think that it is important. Now, all that I think one of the things we have seen through this period of uncertainty is people do get pretty focused on share price performance going on in the underlying operations. So that ESG and responsible investing conversation can probably take a little bit of a back seat. But as we start to come out of it, I would expect that you're going to continue to see investor demand increasing for that direct board engagement.
Yeah, absolutely. Okay, great. On to the next. So another question for everyone. So I guess we've all spent time on the sell side. And I think it'd be great for the audience if you could share an analyst's point of view. What did you expect from companies during a downturn, down market? Any words of wisdom on what not to do? And maybe I'll kick it back to Gus here.
Yeah, sure. I mean, first thing is do not stop communicating. I mean, just because things aren't going your way doesn't mean you should stop the communication flow. I mean, I think it's even more important to be communicating with the street when things aren't working out. They want to understand that you understand the situation, you have plans to address them. And I think the other thing is, don't ignore the issues, right? If recession is on everyone's mind, then you need to address the issue, right? Like, okay, if there's a recession, here's how we think it's going to impact our company, and here's how we'll deal with it. So, I think that's very important. Is more important than ever to communicate in a downturn, and just saying that, oh, we'll be fine is not the response that investors are looking for. They want to understand that, how are you going to get through a tough economic environment if that's what's on their mind.
Yeah, absolutely. Michelle, what do you look for from the sell side in this?
I would say, I think Gus is exactly. I think people just want to know what's going on. They want to understand what things look like. They want to understand how different companies are adjusting and adapting. And so from a sell side standpoint, one of the benefits is that they're looking over a broad spectrum of companies, usually in the same industry. And so they can provide that comparative analysis. I think it is important, to understand what kind of exposures different companies have, whether that's to recession, to that's inflation, what kind of levers and mitigation sort of actions they can take to kind of minimize those impacts on the business, because it helps assess sort of where my particular company fits in terms of the broader industry and spectrum. It also provides ideas. Are there things that other companies are doing that maybe my company should be doing or could be doing? And if they're not doing it, why not? Is there a reason for it, et cetera? So I think that broader sort of scope and lens is also particularly helpful in a downturn.
How, just out of curiosity, how often are you seeing companies be proactive in this, like in terms of actually putting out material around sensitivity analysis? Or is it more happening, behind closed doors, or are they maybe providing that information to the sell side and expecting it to be disseminated that way? I'd love to hear your thoughts on that, Michelle.
I mean, I think companies have got a lot better, right? I mean, particularly those companies that have a lot of exposure, if you look at anyone that has exposure to commodity, interest rate, FX, I think that over the last number of years, they've sort of learned that that's what the market is for in terms of sensitivity. They've gotten better about providing that information. I think to the extent that you can provide that information, provide it in your quarterly release, you don't have to make a big deal of it, but having it even in that release somewhere is really helpful. The analysts will all take that information away and they'll actually put it through analysis, and they'll actually put together the scenarios on behalf of the company in terms of what different things might look like. But I think that that's really helpful, again, for investors to just really understand what is the downside, what's sort of the more reasonable trajectory, what kind of does the company have into place. I think all of that is really important.
Absolutely. Awesome. I think we touched on a lot on this subject, but Ian, just want to double check. Do you have anything to add here?
Yeah, I just, something came to mind as Michelle was speaking. Like, I think if you don't take control over your narrative and put out some of those signals, then you can't expect that you're going to necessarily like how other people express that narrative. So I think being proactive around the downside scenarios and those types of things is good. That being said, I mean, a lot of analysts have access to, economics teams and other very bright analysts on their teams, and they're continuously contextualizing their coverage universe across those different people. So, and I feel for analysts because, they have audiences. The two primary ones are people like Michelle on the buy side and their sales desks, and they need to stay relevant, right? So they need to continue to keep the news flow going. And, I think it's a good opportunity for companies to put out some of these signals around downside protection, defensive characteristics, how a company recovers in a downturn, because it might give the analyst actually an opportunity to put out a thought piece or something like that. So you're really working in partnership with the analysts. So definitely don't go silent on your analyst world. And who knows, Gus picked up 2, he said, within the last couple of months. It's still possible to get new ones in the door.
And maybe on that, Gus, you could enlighten us as to how that came to be. Did you reach out to them? They reached out to you? Was it a long process? What did that look like?
No, actually they reached out to us. So again, pretty fortunate that way. We are in a sector, fintech and SaaS, which is pretty popular, less so more recently, but still remains of interest to investors. And we were pretty fortunate that they were coming to us. We haven't had to target sell side analysts to launch coverage.
Got it. Awesome. Okay, and so Michelle, the next question has to do with during downturn, what kind of analysis would you like to see from the sell side analyst? I'm pretty sure we just covered that, unless you have anything else to add. But
yeah, I don't think I have too much more, but again, just that scenario analysis I think is true. I would say too, just coming back, and this is more from a company perspective, I would say that if you are getting feedback from investors that there's a question that they want addressed, like you need to address it, right? Like a lot of times people will hide, a company will be, investors will be concerned about their leverage level, or they be concerned about what their bottom line, and the company just keeps saying, it's fine, don't worry. I think that the company needs to do, they really need to take those concerns seriously, because as we get into a market downturn, particularly those balance sheet concerns are very top of mind. And I think you really need to be as clear as you can about what the path to lowering your leverage, about what the path to higher profitability looks like, because that's what people are really focused on. And, if you're not doing a good job of getting your message across, that's going to be reflected in your share price.
Absolutely. Awesome. So next question is for Gus and Ian. What is your current posture for 2023 with respect to Lightspeed's IR program? I guess it's Gus, but I think Ian, you can chime in as well. More proactive or less proactive?
I think I'd say for us, probably more proactive. I mean, I think we want the right investors in our stock. So I think we're targeting, long-term investors who understand technology, understand the cycles we're going through, understand our company, and who are willing to be somewhat patient. And so there has been more of an effort to target those kind of investors because, obviously with the macro concerns out there, who knows what's coming, but it just when you can attract investors that do have that tendency to stick around, understand the technology cycle and the macro environment, that's who we're really after. And so we have made more of an effort to go after those kinds of investors.
And so with that, then how do you prioritize your time between targeting and maintaining and growing relationships with current investors?
Yeah, I mean, in terms of maintaining relationships with current investors, we always make an effort after we report results to have discussions with, probably roughly our top 20 investors. So we always kind of prioritize that. Obviously, because they are investors, they do understand the stories. They have met with the management team. If they ever need anything more, we're actually, very, very willing to speak to them. And so I'd say that, the bulk of our time is targeted towards trying to get new investors and more capital into the name, because that helps our existing investors as well, right? So I think that's the focus really is trying to attract more capital and new capital into the name.
Yeah, absolutely. Ian, anything to add here? I know you have more than one client, so maybe it's different across your client base, or is it just the same?
Well, I don't think Gus wants me opining on his program. His program sounds fantastic, by the way, but tactically it sounds like he's doing the right things. And looking at it seriously now. Like, I think we talked about how you need to be proactive. We talked about some of the tactics and strategies that we need to do. And we're advising all of our clients to kind of keep their foot on the IR gas through 2023. And, I think maybe it takes a little bit more hustle this year where, I'll use just very rough numbers. Say you've got a portfolio, and maybe I'm completely off, Michelle, but say you've got a portfolio that's 20% cash sitting through 2023. So just by the numbers, you've got 20% less meetings occurring. So it's going to take you maybe a little bit more time to identify those investors, maybe to find the right broker to get you in the door, maybe to figure out some of those channels to new retail audiences. So I think it does take a bit more hustle. I think it's also a good time for companies to look at, what is their toolkit of IR communications and how can they amp that up? So maybe it's not through the annual report or your quarterly disclosures, but maybe it's your website. Maybe again, we talked about social channels. Maybe it's some other innovative ways to, enable investors to consume investment information about your business. So, I think it's still an opportunity, even if the markets are looking a bit choppy at the moment.
Is that true, Michelle, in the sense that, if you're holding more cash, are you taking less meetings or fewer meetings?
So I would say that doesn't tend to be the way that we run our specific portfolios. We tend to be pretty fully invested, just as that's the way that our mandates are structured, but there certainly are investors where that's the case. I would say that, we are obviously taking, I think, as I mentioned, more meetings. It's important to be consistent. I would say we tend to take more meetings with companies where the challenges are greater. But you're also there's a lot of opportunity in a sense, right? Like you're in a if your companies are not performing or they're not doing the things that you think they should be doing, your conviction is falling. And what that means is that you need to replace the portfolio, because every time we sell a name, we tend to replace it with something else. And so most portfolio managers will have sort of a watch list or sort of a list of companies that they've been following for a period of time. And it's those companies that actually have the opportunity to rise up in this type of opportunity. And as the market starts to look a little bit better and a little bit more stable, maybe you get a portfolio manager that's willing to make that switch. So, it can actually be a good time to see that turnover in portfolios increasing as well.
That's great. Also, I was thinking that it might be a good opportunity to ask you some ESG related questions, given that you're the expert here. And so from me, I'm wondering whether, ESG, that the fact that, we're going through a downturn and ESG is sort of going through an upturn in terms of importance and recognition and whatnot. Do you have any words on that and whether it's being affected at all, given the fact that the market is pulling off, or has it just been sort of consistent? Let's continue to drive forward with it across how you manage your money on behalf of your clients and how companies that you invest in, roll out their ESG governance.
I would say that, it's sort of a twofold answer. I would say that when we go to our investor meetings, when people look in our performance, people are concerned about performance, right? People are there's a lot going on in the market. There's a lot of uncertainty. The macro environment is, lots of moving parts. And so people want to talk about that. And so that has been a bigger focus of most of the meetings that we would have over the course of the past year. But ESG has not gone away and it's not going away. I would say, we spent a couple of years where ESG was very, very top of mind because it was a bit newer in terms of how people were addressing it, how people were talking about it. And I would say that we've almost reached a bit of a maturation phase where there is now an expectation that your ESG program or your response, is actually pretty well developed now. You can answer the questions. Ideally, you're getting close to having a sustainability report. If you don't have one already, you've looked through your disclosure and figured out what you need to do. So I think it is increasingly important. I think that, when I look across the asset manager space, ESG it's table stakes, right, in terms of what investment managers are doing and looking at and thinking of. So I would say if I look at our client base, the people that are giving us money to invest, there is no one out there that doesn't want to know what we're doing from an ESG standpoint and how it's being fully integrated across our portfolios. And what that means is that our expectation is that companies are able to meet sort of the information needs that we have, and we're able to understand what their ESG programs are looking like.
Got it. That's
Hey,
great.
David, I have just one kind of anecdote on that front. We have a client that we helped do an ESG, their inaugural ESG report last year, which, as ESG reports do, they set out a number of new non-financial, pre-financial performance metrics. Investors need to understand what those are for each company. And then what they do, people like Michelle, is track it. Okay, well, how is this company done over time? And they may not report on it every quarter, but if you've said, okay, by 2023, I'm going to do this, then the Michelles of the world can expect that you're going to tell them what you did. So, just because times are tough, I don't think you should really consider, okay, do we turn off that new ESG signal to our audiences and our stakeholders? If anything, it's more important because you've established that channel and you still need to build credibility around it. So, so our advice is you just got to stay the course. And I think Michelle's absolutely right that this is table stakes now.
Absolutely. Awesome. Okay, so we have a few questions from the audience here, which I will read, and then we can select who's going to answer them from there. So the first one, when you talk about speaking with investors, are you calling the analysts, calling companies directly, or sending press releases? So Gus, I think the question is essentially asking, like, how are you targeting, and sort of what's your workflow for that?
How we're targeting specific investors, you mean, or?
Yeah, I think so. Yeah.
So I mean, I keep track of everybody that we speak to using Irwin, and so I think that we have a sense of who is it that we would like to get in the stock, and then who has shown interest, and then we narrow down that list, and then kind of start pursuing them. We had a discussion, just wanted to follow up and update you as to where we are and see where you're at. So I think that, there's no point pursuing people that don't want to talk to you, right?
Sure.
So you first have a level of, you have to gauge who has interest, and then who you want to form stronger relationships with. And, using tools like Irwin, we can try to target those investors and go after them a little more aggressively. Got it.
Ian, anything you would add to that?
A couple of things. One is that the press release option, I always tend to reserve for, the disclosure of material and non-public information. I think the last thing that I want my companies to do is abuse that press release channel, because then you start to, people, they might discount the value of that channel from that company. So, I mean, press releases should be important in and of themselves. And then the other, just the way the question was asked, like, do you call the analysts? I think definitely you do. Analysts are typically very careful on not saying an investor's name. But they might, if you say an investor's name to them, they'll say, okay, I have a good relationship with Michelle. Okay, my colleague has a better one. So they can be a good inroad to an investor. And then to Gus's point, I think you can use resources like Irwin and others to make direct contact with companies. So, some may not take your call as readily, but, I think you should definitely make the attempt. And then the other thing is, I always watch my call logs for my quarterly calls, see who the new names that creep onto that list are. And that's an indication of interest. And, there's a basis for a return call to that investor if they've been, listening to your calls.
Absolutely. Here's another good one and somewhat related. So what is the typical length of your first outreach email? And what are some key elements that you touch on? Who wants to take that? And maybe also, Michelle, it'd be great to hear from you as to what you like to see.
I mean, I probably prefer to have Ian and Gus. I think they probably have more experience. I would say, the challenge, you get a lot of outreach emails. And so, again, coming back to Gus's point, if it needs to be a company, or there probably needs to be something distinctive about it to sort of catch my attention, just because of the flow of information that's put in front of me. So what differentiates your story? What makes it interesting? Like, why is it that I'm looking at this? It's very helpful if you can get, whether it's an analyst or a salesperson, to kind of say, you know what, I've looked at this, I've understand it in the context of the industry and the other players in this market, and I actually think this company looks pretty interesting. So maybe you want to look at it. So I think if you can make that connection or have that connection made for you, I think that that's really helpful. But, just a direct outreach from a company, I would say it's harder to have a direct impact.
Yeah. we actually, across our client base, we have the benefit of seeing what works and what doesn't work. And so based on that, we've built several templates accessible to Irwin users. But generally speaking, they're all fairly short and to the point, where, here's your market cap, your sector, subsector, insider ownership. Here are some catalysts, reasons to look at us right now. And that's pretty much it, right? Because to your point, Michelle, I know you're inundated with a lot of information, and just writing paragraph after paragraph generally just does not work. Here's another question that I think is for you, Michelle. So I'm curious to know if individual investors such as retail advisors, high net worth individuals, et cetera, are specifically asking their money managers to invest in high ESG score companies, or are they using the term ESG, or are they asking for the money to do good, invest in companies with an environmental impact, social goals, things like that?
Yeah, I mean, it's a great question, and I think that the answer is probably all of the above. I mean, I think one of the challenges with responsible investing today is that there's still confusion around it. There's a lot of education that needs to be brought out there, and so what responsible investing means to one investor might be very different than what it means to another. So you've highlighted some of the key things that we really try, and we're putting together materials all the time in terms of how investors can think about it. Is it really about you just want ESG integration because it's a risk management tool, and we recognize that climate change, for example, impacts all companies and all industries, and we need to understand what kind of risks and opportunities it poses for its companies, or is it really more of a values-based orientation? And I think that you direct different clients to different products and different strategies depending on how they feel about those things. So I would say that the spectrum is wide in terms of what investors are looking for, and I think it's important as a again, you're not trying to cater to one of those specific types of asks. I think you're really focused on, as a company, what is my ESG performance, doing the best job that I can on all of our things, being able to myself on an ESG standpoint, and then letting the investment managers kind of figure out what products it made sense to put your particular story into.
Makes sense. That's great. Thank you. Okay, and so here's another one that I think is relevant. So how can IROs accurately measure success or progress during a market downturn? What are the most important items I should present to management? So I think this is probably one for Gus and Ian.
Yeah, it's kind of hard. I think one of the ways I look at measuring success is who are the people buying your stock, right? If obviously the ownership, especially for as you're transitioning from growth to value, the ownership is going to change. And it's, if you look at your top 10 shareholders, I mean, are those the shareholders that you want in the name? And if the answer is yes, then I think then you're probably doing a pretty decent job. If the answer is no, then you may want to have to reconsider your strategy.
Yeah. My 2 cents on this is that an investor relations strategy can be broad, but either way, it needs to be set, right, with specific goals. Otherwise, you're just not going to know, whether you're doing a good job or not. And those goals could be, X amount of shareholders that have this profile, X amount of meetings with these kinds of shareholders. It could be turnover, many different things like that. But our experience, if they're not noted and accurately measured or frequently measured, then there's no point. Ian, maybe just while we have time for one more, I'll direct this one to you. So from a targeting perspective, has it become more important to look at international investors so that all your eggs are not in one basket, i.e. North America?
Yeah, the international question for a Canadian company is always a challenging one. So, I just looking at a couple of my clients, they've seen a big uptick in the holdings from European investors. And, sometimes you wonder where that activity comes from. Like, are some of your brokers actually, their channels extending that far, and their research is being consumed and driving that investment activity? But, I think going to conferences internationally might be quite tough. So it's, how do I work with my brokers and my covering analyst communities to get into those those audiences? And with MiFID II, I think the whole approach I've found, and if people have advice, I'd love to chat with them. It is more challenging to get in front of international investors, and I'm thinking outside North America now. You know, different platforms have different strengths in different markets, and some, you know, would probably freely admit that they're not as strong in Europe as they were, say, 10 years ago. So yes, they're important. They have massive amounts of capital to invest. It's really just over to your investment banking relationships and figuring out who has inroads to some of those larger pools of capital internationally. I mean, I think it's Norges Bank that owns 1/6 of all securities in the world or something like that. Pretty important investor, but they're not going to look at everything. You have to think they're going to be very mega cap biased. But there are really important international investor audiences. So.
Yeah, and I can speak to that. Again, across our client base, we've had a lot of success with clients finding investors outside of North America, in Europe, in Asia, in continental Australia. And sometimes it's with an investment bank, sometimes it's not, sometimes it's through data and Irwin, but they definitely are out there and can be amazing shareholders. So I would certainly encourage everyone to, at the very least, try. So with that, I think we'll be wrapping it up. I just want to say a very big thank you again from Irwin and LodeRock. Thank you so much to our panelists. You guys did an amazing job. If you'd like more information on Irwin, feel free to visit getirwin.com. And more information on LodeRock can be found at loderockadvisors.com, or you can follow us on LinkedIn, where we post topical and educational content regularly. Thank you all so much. Have a great day, and looking forward to the next webinar. Take care. Bye.